Hey everyone, welcome back to Corporate Decoder. Today, Fidelity Trust just filed their N-CSR report for May 31, 2026, and I am seeing something interesting in their holdings. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a really clear snapshot of where a massive amount of money is parked right now, and it shows a strong focus on the tech giants that have been driving the market. Alright, first up, let's look at the big picture for the Fidelity Nasdaq Composite Index ETF. As of May 31, 2026, the fund itself is massive with over $10 billion in assets under management. They hold over 1,000 different companies, which is pretty standard for an index fund. Now, where is all that money going? If you look at the market sectors, this fund is heavily invested in information technology that is over 54% of their net assets. That means more than half of this $10 billion is tied up in tech companies. And when we dig into their top holdings, the names you would expect are there. Apple Inc., for example, makes up a full 10% of the entire fund. Microsoft Corporation is also a big player at 7.4%. Amazon.com Incorporated is close behind at 6.4%. And of course, NVIDIA Corporation, the darling of the AI boom, is their number one holding at 11.3%. These top 10 companies alone make up over 58% of the fund. This is a heavily concentrated bet on a few massive tech companies that have been performing exceptionally well. It shows a clear strategy of following the major market trends. Geographically, the fund is overwhelmingly invested in the United States. Almost all of its assets, 97.1%, are in US companies. That shows a trust in the American economy and its leading technology sector. Flipping over to the schedule of investments gives us a huge detailed look at every single position. It is a very long list, but it really confirms that heavy concentration in technology. For instance, you can see NVIDIA Corporation with over $1.2 billion invested. That's a huge chunk of change if that investment were to falter. And Apple Inc. is right there with over $1.09 billion. The sheer size of these positions means any significant movement in these companies will heavily impact the fund's overall performance. Microsoft Corporation also shows a massive investment of more than $795 million. It really drives home the point that this fund is largely betting on the continued success of these tech titans. Beyond the common stocks, which make up 99.5% of the fund, most of the rest is short-term investments and net other assets and liabilities. It is a very stable structure focused on equity. Now let's look at the fund's financial performance. The statement of operations for the 6 months ending May 31, 2026 shows a net investment income of over $24 million. That is from dividends and interest income. Scroll net realized gain losses on investment securities. Scroll, but where the real money is made for this fund is in the gains on investments. They saw a net realized gain of over $267 million from selling investments. In addition to that, the change in unrealized appreciation on their holdings was over $1.1 billion. That is a massive increase in the value of their existing investments. This massive unrealized gain means the value of their holdings has gone up significantly without them even selling anything. It is a reflection of the strong performance in the tech sector. Overall, the fund saw a net increase in its assets from operations of nearly $1.5 billion during this 6-month period. That is a very strong performance. Looking at the statement of changes in net assets, we see that total increase of over $1.4 billion from operations. They also had increases from share transactions, meaning more money came in from investors buying shares than went out from investors selling shares. This brought the total increase in net assets to over $1.5 billion for the 6-month period. This surge in assets is reflected directly in the net asset value per S-share. For the 6 months ending May 31, 2026, the NAV per S-share grew from $91.97 to $106.20. That is a significant jump. The total return for this period was 15.81%. That is a very solid return in just 6 months. For context, looking at the full year in 2025, the fund saw a total return of 22.20%. These numbers show the power of this tech-heavy strategy when the market is moving upwards. Now let's talk about costs. The expense ratio for this fund is incredibly low at 0.21%. This basically means for every $100 invested, they take out about 21 cents for management and operating costs. That is very efficient, especially for a fund managing over $10 billion. It is hard to find a comparable fund that is more cost effective. The management fee is set at 0.21% annually. This fee is paid to Fidelity Management and Research Company LLC. They are responsible for managing the fund's investments, and they also pay for most of the fund's operating expenses. It is also interesting to note that Geode Capital Management LLC serves as a sub-advisor for this fund. This means while Fidelity is the main manager, Geode also plays a role in the day-to-day investment decisions. The report also mentions the Board of Trustees reviewed and approved the investment advisory contracts. They decided to continue the agreement with Fidelity Management and Research Company LLC and sub-advisors for a couple of months, while they consider a longer-term renewal. They looked at fees, expenses, investment performance, and profitability and concluded the current agreements are fair and reasonable. Looking at this filing, it is clear that Fidelity Commonwealth Trust, through its Nasdaq Composite Index ETF, is making a very big bet on the continued dominance of a few major technology companies. The concentration in the top holdings like NVIDIA, Apple, and Microsoft means the fund's performance is tightly linked to the fortunes of these giants. The low expense ratio is a definite plus for investors. However, this concentration also represents a risk. If any of these core tech companies were to face significant challenges, or if the broader tech sector were to cool down, the fund would likely feel a substantial impact. The fund is essentially riding the wave of current market leaders, and its success hinges on their sustained growth. It's a strategy that has paid off handsomely recently, but investors should be aware of the potential downside if that trend reverses. The key for any investor here is to understand their own risk tolerance in relation to this heavy tech exposure. All and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.